Hi, welcome. It is perhaps a sign of the times that I had to spend a few minutes thinking about the title for this session as much as I thought about the content. This session I want to talk about what I call the sugar daddy effect. And already you can see my problem, right? There will be people who will be offended by that title. I considered changing it. To do what? Expanding it to molasses mommies, that way you couldn't be accused of sexist. But then I said, that sounds awkward. How about something that's gender neutral? How about glucose guardians? That didn't sound right either. I'm going to stick with this title, and I'll be quite honest, I'm far too old to care if you refuse to watch this session because of the title. I mean, after all, the people who'd be offended by this title are probably not the type of people I'd be wanting to watch this session anyway. So I want to talk about the sugar daddy effect. And what I'm talking about here is the fact that if you have a bountiful benefactor, somebody who supplies or meets every one of your financial needs, you have little incentive to become financially independent. You think, so what? Why is this even a finance theme? I'm going to talk about three groups of entities that I think have the sugar daddy effect. I'm going to start with corporate venture capital. Corporate venture capital are venture capital arms within established companies. These companies are often successful in their core businesses. They have so much cash coming out that they start a corporate venture capital business. We'll talk about corporate venture capital in the aggregate. We'll talk about how it's structured, what the motives are, and why corporate venture capital might be punching under its weight. And that's going to be a theme you're going to see play out in all three groups. The second thing I want to talk about, or the second grouping I want to talk about, are sovereign wealth funds. What are sovereign wealth funds? They're essentially funds created by governments with government funding. Usually the funding comes from a commodity that government has been able to access to. And that sovereign wealth fund, again, has multiple missions. We'll talk about what they are. The third group that I want to bring in is green investing. Green investing in companies and funds, essentially a destination for impact investors over the last 2 decades. So all three groups, here's what they share in common. They have a funding source that continues to supply them funding almost independent of how they perform. I'm going to argue that that practice might be at the heart of why these three groups collectively struggle to deliver results that are consistent with their size and to punch at their weight. So let's start with corporate venture capital. Why do companies start on corporate venture capital? At the risk of drawing a structure that I've used before to explain things, let's go back to the corporate life cycle. If you're a young company looking at potential, you're not interested in corporate venture capital. Every dollar you have goes back into the business. So early on, you have negative earnings, negative cash flows, lots of growth potential. Your investments will tend to be internal investments. As you grow out, maybe you will look outward because you're still interested in growth, maybe at acquisitions. But it's only as you start maturing as a company, your earnings are coming in, your cash flows are positive, you don't have enough in investment needs, that you turn to corporate venture capital. And not all companies do, but some of them do. So if you think about where you're going to see corporate venture capital show up the most, it's in the maturing and mature phases of the life cycle. Now, there are two simple reasons why some companies move to corporate venture capital. It becomes a substitute for internal investment. I mean, let's take the first example, replacement for internal R&D. Increasingly over the last couple of decades, you've seen large pharma companies not wind down their internal R&D, but scale them down and invest more of their money in young biotech companies, young pharma companies, essentially using corporate venture capital as a way of seeding other companies to do research for them. In other words, they've outsourced their R&D. In other businesses, especially ones where there's tremendous uncertainty about what the future will hold, you will often see a company take positions in multiple technologies, even competing technologies. Why would they do that? Because they're not sure which technology is going to win, and they want to make sure that whichever wins, they still have a stake in that winning technology. This is closer to investing in options. You invest in 50, 30, 40 young tech companies. You don't expect all of them to pay off, but you expect the few that pay off to cover the cost of the rest. So those are the two conventional reasons for corporate venture capitalists, as a replacement for internal R&D and as real options in technologies that you hope will pay off. There are two other reasons companies might give for investing in corporate venture capital. You might invest in companies because you think you will get side benefits to your core business. So if you're Google and your core business is advertising, you might invest in startups and young companies that you think will make your advertising business more profitable, larger. So the side benefits come to core businesses. They don't go to the standalone companies themselves, but the parent company benefits. In some cases, and this is rare, there are companies that open up a corporate venture capital arm because as a new business. In other words, they behave like traditional venture capitalists. What did they do? They seed startups. And just like traditional venture capitalists, they try to exit. Exit by doing what? By selling the company to another company at a higher price, taking it public, more like a traditional VC business. Already you can see that the motives for corporate venture capital can create a vast array of different corporate venture capital entities. And even within the same corporate venture capital arm, you might find different investments with different motives. Along the way, if you look at how corporate venture capital has been structured, in most companies, it's not a standalone independent entity. And maybe this is a problem because we'll come back and talk about accountability. But corporate venture capital is an off-balance sheet entity without standing on its own. It's not that independent. It's not that accountable. And the capital commitments to the parent company can range the spectrum. Some corporate venture capital entities get multi-year capital commitments. They have the maximum independence. Some get it on an annual basis. They've got to re-earn that commitment every year, little less independence. And still other companies, it's whatever's left over that year. It's a residual cash flow being invested, which means as a corporate venture capital arm, you have no idea what you'll be investing in a particular year. So companies that have corporate venture capital, lots of different motives, usually structured as part of the company, not as an independent entity. Now, I would say, how big is corporate venture capital? It's big and getting bigger. In this graph, I look at total venture capital raised and the total from corporate venture capital. And then I look at the percentage of total venture capital that comes from corporate venture capital. It's increased from about less than 25% to close to 50% by the time you get to 2023. It is worth noting, though, that if you look at the number of deals done by corporate venture capitalists, it's well below 50%. It's closer to 20 to 25%. So how do I explain the discrepancy? Very simply, by looking at the types of deals that are funded by corporate venture capital as opposed to traditional venture capital. In this graph, that's exactly what I do. I look at the pre- and post-money valuations of companies funded with traditional venture capital, as well as the companies funded with corporate venture capital. Take a look by year at the contrast. In every single year, corporate venture capital backed companies tend to be bigger, get more funding, and become larger post-deal. Corporate venture capital might not do as many deals as traditional venture capitalists, but they do much bigger deals, which explains why almost half of all venture capital money comes from corporate venture capital. So corporate venture capital is big. That's undeniable. Now let's look at performance. Are they delivering returns that justify the investment? What makes that assessment difficult is the mixed missions we talked about. In fact, if you look at corporate venture capitalists, they classify themselves based on what their end mission is, and this is from a survey, so it's a self assessment of what they're expected to do. Only 15% of corporate venture capital funds say that their end game is purely financial. In other words, you can measure them based on entry and exit values like a traditional venture capitalist. 47% of funds use the word strategic. And that's a scary word, as you've heard me say before, because it effectively means we have other missions. They're long-term. They could be side benefits of the company. I'm not denying that those missions exist, but it basically means that it's going to be much more difficult at assessing performance. And finally, you have hybrid funds that claim they're both financial and strategic reasons. Now, given that mixed mission, let's look at what corporate venture capitalists tend to do. This is from a graph, and this is actually an interesting graph, as what happens at companies which are backed by venture capitalists as opposed to corporate venture capitalists. We already talked about how corporate venture capital backed companies tend to be larger than traditional venture capital backed companies. It also turns out that there are other differences, and this is from an assessment in 2023, and you can go back and look at previous years. So if you look at the companies, it turns out that corporate venture capital deals tend to fail less frequently and that they get to more funding to stay in business. Now, if you're the company getting the funding, this is good, right? Corporate venture capital-backed companies tend to get more funding, fail less. But there is a dark side to this, which if you think about venture capital and you put your money in a startup, knowing when to fold your cards, cut off funding, is critical in being a successful venture capitalist. Turns out that corporate venture capitalists don't do that as often as traditional venture capitalists. We'll come back and talk more about that later. So if you look in the aggregate, it doesn't look like corporate venture capital. It delivers the kinds of returns you'd expect it to, or that its corporate parents expect it to. In fact, if you look at stock price reactions to companies with corporate venture capital arms, it turns out that markets tend to be much less enthusiastic about the payoff to corporate venture capitalists than managers are. In fact, in the 61 firms studied in a 2010 study, dated, I know, it turns out the stock price reaction to a company announcing it's going to make corporate venture capital investments is negative. Shareholders don't buy into the upside or the side effects being positive. Now again, this is not conclusive proof. We'll come back and look at corporate venture capital performance for individual corporate venture capital entities. But in the aggregate, I think it's fairly safe to say that corporate venture capitalists don't deliver the kinds of returns that traditional venture capitalists do. Let's move on to sovereign funds. If you look at what the motives are, it's worth noting that 60% of sovereign funds around the world have been created in commodity companies and funded with commodity wealth. The most widely used commodity for these sovereign funds is, of course, oil. The very first sovereign fund was created by Kuwait in 1953 using oil riches as a starting point. And it's become the template for a lot of sovereign funds. Now, why are these sovereign funds created? Put simply, a company with oil reserves knows that it's a finite resource. The oil is going to run out. And you want to collect the funding while there is oil and use it to invest those funds for the long-term benefits of citizens, at least in theory. But many of these sovereign funds are also given other missions. We'll come back and talk about them. Incidentally, one big difference between sovereign funds and traditional mutual funds is sovereign funds tend to control more of the portfolio process. They're in charge of asset allocation, security selection, even performance evaluation. Whereas in traditional funding, you often get a separation. You tend to be either an equity fund manager or an asset allocator or a performance evaluator. All of that gets bundled into a sovereign fund. What are the side motives for sovereign funds? Let me use a few examples to illustrate what the side motives might be. One of the largest sovereign funds in the world is the Public Investment Fund, PIFs, Saudi Arabia's sovereign fund. It's been given the mission of delivering on Vision 2030. What's Vision 2030? It's a kingdom's plan to wean the Saudi Arabian economy away from oil and make it a more diverse economy. So it's got to invest a significant proportion of its money in Saudi-based businesses, aviation, defense, entertainment, tourism, sports. There are some sovereign funds that are required to invest in green energy. Why? Because it's the right thing to do for the planet. Norges, which is the largest sovereign fund in the world, it's a Norwegian fund, has to invest a portion of its funding in wind and solar infrastructure. There are some sovereign funds that are given the mission of strengthening a sector. The China Investment Corporation, another very large sovereign fund, in addition to maximizing returns for a given level of risk, is also asked to preserve and recapitalize domestic financial institutions. You can put banks in quotes there. That's part of its mission statement. So in addition to managing money like a traditional fund manager, you're given a pretty significant side mission. So let's start by looking how big sovereign funds are. They're huge. Collectively, sovereign funds at the end of 2023 had more than $12 trillion to invest. And the number of sovereign funds has risen over time, especially in this century. Close to 100 sovereign funds out there with $12 trillion to invest. Now, if you break it down and look at the largest players, the Norges fund is the Norwegian sovereign fund, followed by, there are five Asian funds, 3 from China, 2 from Singapore. GIC and Temasek are the same. But you see a mix of oil-based sovereign funds and Asian funds. Those are the 10 biggest funds. The US does not have a sovereign fund yet, but one of the US states, Alaska, has a sovereign fund, if you can call it sovereign because it's state sovereign, funded again by oil wealth, where every Alaska citizen who's lived in the state for more than a year gets a dividend from the fund. I think it was about $1,300 in 2023. I said earlier that sovereign funds do control a larger portion of the portfolio process. And that can be seen when you look at the mix of assets in sovereign funds. In this graph, I look in three particular years, 2016, 2020, and 2024. And you can see the mix of asset classes is wide. You've got equity at about 25 to 35%. You've got fixed income, but you also have direct strategic investments that these funds make in businesses or other investments. You got cash, and you got alternative investments. Alternative liquid investments in the sense that these are investments they can get out of quickly. So you can see that sovereign wealth fund asset allocations represent a mix of asset classes, which is going to become a bit of an issue when you think about performance evaluation. Now again, I'm going to talk about aggregate performance, but then I'm going to isolate individual sovereign wealth funds and see if we can contrast them. If you look at sovereign wealth funding in the sovereign wealth funds in the aggregate, they do underperform. Equity in companies targeted by sovereign wealth funds underperform the market significantly, but there's a caveat. The performance tends to be better at transparent sovereign wealth funds, and we'll talk about where the transparency comes in versus opaque ones. If you look at corporate performance improvement, because sovereign funds have the money to be activist investors, the results are mixed. In companies where the sovereign wealth fund holdings are small, there are increases in profitability. But where they're large, there are actually decreases in profitability, which cuts against the activist investing thesis because it's the larger holdings where you're supposed to make changes. So if there's a core mission here, it doesn't look like in the aggregate sovereign wealth funds are delivering what you'd expect them to. But here's where the diversity kicks in. If you look at the very best sovereign funds, they not only match the very best regular mutual funds, they outperform them. I mean, one of the largest sovereign wealth fund in the world, the Norwegian fund, is actually incredibly transparent about how it's structured, how it's organized, how it's managed, and about its performance. And every year they report their performance relative to a benchmark. That makes them unusual already. And it turns out that since their inception, which was in the late 1990s, this fund has matched the market or delivered slightly more. You're saying just slightly more? That puts them way ahead of the typical active money manager. That's the best of the funds. What about the worst of the funds? The worst of the funds are opaque. You have no idea who runs them, who hires the people who run them, and how the money is allocated across investments. You probably either read about 1MDB, which is the Malaysian sovereign fund set up in 2009, again with oil money, and how that fund unraveled because it used its money to fund Hollywood movies and things completely unrelated to its core missions. So somewhere between Norges and 1MDB lie most sovereign funds, and you have to decide where you lie in that spectrum to get a sense of how the sovereign fund performs. Which brings me to my third and final grouping, green investing. Why do people invest in green companies and green funds? Well, this is again a mixed mission, right? Part of it, and presumably the key part of it, is to make the world a better place, to reduce climate change, to create decarbonization, to reduce dependence on fossil fuels. Now, there are some investors in the green investing space to whom this is the core mission, and they will accept lower returns as a consequence. So foundations, endowments might say, look, we're okay earning less than the market because we're making the world a better place. I wish that were true for the bulk of impact investors, which tend to be the investors investing in the green investing space. This is from a survey of investors in impact investing, asking them, what do you hope to get out of this green investing? And if you look at pension funds and insurance companies or for-profit asset managers, you know why they're in green investing? Because they think they can make the world a better place while earning an alpha, earning more than the market. They want to have their cake and eat it too. And we'll see this theme play out over and over again in green investing. So the motives presumably are a mix of making the world a better place and managing your money, but some people are clearly unrealistic about what can be delivered. Let's look at how much money has been invested in green investing. You can have all kinds of critiques about how the fight against climate change is evolving. But one of the arguments you cannot make is not enough money is being invested in it. In both equity and bond markets, green bonds and green equity, the amount of money invested in green energy has been astonishing. This graph, I compare the amount invested in fossil fuel companies, and we agree that they're bad, we don't want them to grow, versus green investing. And ever since the middle of the last decade, you see green investing pick up. And by the time you get to 2022, 23, and 24, almost twice as much money is invested in green investing than in fossil fuels. Much of that green investing is nature's energy, wind, solar, hydro. Clearly, a lot of money is being invested. But if you look at performance, again, very mixed results. On the financial side, if you think about the trillions of dollars, and it's trillions of dollars invested in green investing, you'd expect some great green energy companies to at least start showing up, right? So I downloaded every publicly traded company in the alternative energy space, which includes every aspect of green energy. There were 273 publicly traded companies. Their collective market cap was $506 billion. And they reported aggregated revenues of $117 billion. You're saying, so what? What am I supposed to do with it? One fossil fuel company, ExxonMobil, had a market cap of $532 billion and generated more than 4 times as much revenue. Spent all this money, but there's, the business building side hasn't shown up. You're saying, what about the investor side? There was a period in the middle of the last decade where green investors actually earned returns higher than the market. They patted themselves on the back on how they could be good and make money at the same time. That's faded. Especially in this decade, you've seen fossil fuels kind of re-enter the space and deliver returns again. Clearly, on the financial side, the results are at best blah. But you think that's okay? It was never about the money anyway, so it was about weaning ourselves away from fossil fuels. Well, let's look at how well that's worked. In 2005, we got 86.5% of our energy from fossil fuels. 20 years later, how many COPs have happened? 20 COPs at least. COPs are, of course, those annual climate meetings where the apocalypse is around the corner and we're told to set targets. 20 years after we've had this climate change investing pick up, green investing pick up, trillions of dollars later, how much of our energy we get from fossil fuels? 81.5%. You're saying that's good. We've lowered our dependence on fossil fuels by 5%. But 5%? If I'm to believe climate change catastrophe is around the corner, 5% is not going to do it, right? But here's a more interesting statistic. You know that our dependence on fossil fuels dropped by more between 1965 and 95 than it did between 2005 and 2023. Years before green energy was even a glimmer in people's eyes. And that dependence, the decrease in dependence, came from one source of energy, nuclear energy, which somehow in this entire debate has become a bad form of energy, at least for green investors. So both on a financial and a performance basis, the question you got to ask is, where's the beef? But you say, but there's a lot of innovation that's happened. All that money invested in green investing has created innovation in new technologies. But I wonder whether the kind of innovation and technologies we've nurtured are the ones we would have if we hadn't had a fire hose, trillions of dollars of capital raining down on them. Maybe we've invested in the wrong places. In fact, there's research starting to percolate through the system. And you're welcome to search it out. I can give you the references. That investing in brown innovations. You're saying, what are brown innovations? These are, making fossil fuel, more friendly, more climate change friendly, reducing the emissions. That kind of spending actually gives you a much bigger payoff in terms of reduction in carbon footprint than green innovations. And finally, as we said saw in the earlier graph, the one source of energy that has a chance of filling in our needs, filling in what fossil fuel delivers, which is nuclear energy, we've completely ignored. Just as a what if, what if we taken 1 trillion out of those 10 trillion plus that we invest in green energy and redirected to delivering nuclear energy more safely? Would we be further along? I don't know. It's a hypothetical. I don't know the answer, but I have a feeling we would be. So across the board, whether you're talking about corporate wealth, corporate venture capital, whether you're talking about sovereign wealth funds or green investing, in the aggregate, it looks like we get underperformance. That's what I meant by punching under their weight. Given the amount of money they've got brought to the table, why aren't they doing more? And I think there are 4 reasons why this has happened. The first is that their funding is in a sense assured. It might not be the same funding. They might have to answer questions. But if you're a corporate venture capitalist, let's say you are Google Ventures, you know you can go back to your parent company, and the parent company is rich enough, has enough cash that they can fund you. Sovereign wealth funds, you go back to the government. Green investing, you go back to impact investors. And I think that you take away the desperation. You're saying, why is desperation a good thing? Because in many businesses, desperation is what forces you to think about creating core business models at work. Second problem, we talked about the mixed mission. It's tough enough to run an entity with a single mission. But if I give you 2 missions with no measure of which one is the more significant one, it's an impossible task. Third is, if you look at each of these 3 entities that have structured, you have stakeholder distractions. With the corporate venture capital, it's a parent company saying, oh, by the way, while you invest in startups, we'd like the side benefit for our core business. With sovereign wealth funds, it's a government giving you money saying, make the highest returns you can. And by the way, also build infrastructure in the country that nobody else is willing to build. With green investing, it's, hey, here's the money, but by the way, reduce the carbon footprint by X%. There are lots of stakeholders pulling you in different directions. And sometimes those stakeholders can have enough weight to pull you away from your core mission. And fourth, and this is not true for all CVCs or sovereign wealth funds or green funds, but it is true that there's less accountability with these entities than there is with their traditional peer group. So is there a fix? Well, I think there's at least a partial fix, and you might not agree with me on these, but here are some of the things we can do to make sovereign wealth funds, corporate venture capital, and green investing more effective. First, I think we need to grant these entities much more independence. Remember at the start of the corporate wealth venture capital section, I said that most corporate venture capital arms are not set up as independent. Maybe we need to rethink that. We need more independence. Second, I think we need more transparency at every level. When companies have corporate venture capitals, they need to reveal how much was invested in the corporate venture capital arm, as well as the returns they're making each year, as well as what they're invested in. They can't leave us with this pie of, we can't tell you what we've invested in for proprietary reasons. Same thing with sovereign wealth funds. In fact, as you noticed, transparent funds do much better than opaque funds. So I think it needs to be built into the system that you need independence and transparency. Third, I think you need to separate the motives. As I said, I understand that there are mixed motives with these, and it's fine. You need to separate the motives, give each entity their core motive. This is your core motive, their side motive, and how much money they have available to play it. But there have to be guardrails on the side motive, because otherwise they can hijack the fund. And fourth, you need accountability. In what sense? Not only in terms of looking at year-to-year returns, but knowing when to cut off a fund when it's not delivering. Whether it's a corporate venture capital fund, a sovereign wealth fund, or a green fund. If you get to a point where you realize that they're not delivering, either on their core or side mission, maybe it's time to let go. If you look at failure rates, I think that's what you will notice is a far less failure rate with these entities than there is with their more traditional status quo players in the space. So when I started this session, I started with the hypothesis that the sugar daddy syndrome cut across the board, that sovereign wealth funds and corporate venture capital and green investing underperformed. In the aggregate, that hypothesis holds up. But if you dig a little deeper, it turns out that the best players in each group match up to the top players in their peer groups. The best CVCs are as good or even better than the traditional VCs because they have an added advantage of assured funding. So it's not across the board, but in the aggregate. The key difference, as I said, is there's far less failure within these groups than there is in traditional groups. If you look at traditional venture capital in 2023, for instance, 38% of traditional venture capitalists stopped investing. There was no deal making. There's a lot of failure, a lot of pruning of the worst among the worst performers. You don't have that enough in these groups. So if there's a change I would push for, it's, hey, go for corporate venture capital. Be as willing to cut that corporate venture capital arm off as a traditional venture capitalist, perhaps with a longer time horizon, if it doesn't work out. Are there broader lessons? Yes. And I think these lessons cut across and beyond the three groups that I talked about. One is, if you're funding something, that funding can never be unchecked. There have to be contingencies. You can make those contingencies long-term. It doesn't mean you have to be short-term, but there have to be contingencies under which the funding will be cut off. Second, every entity has to have a core mission. You can have 3 or 4 different things you want an entity to do, but you got to tell them this is your core mission. Those are your constraints or side missions. So if you're a sovereign wealth fund, you should know upfront whether your job is to deliver market matching or market beating returns. Is that your core mission? Or is it to build a nation's infrastructure? Because your choices will be driven by that core mission. Third, to the extent that you have a social purpose, that's fine. But that social purpose has to come with reality checks. The truth is, when you try to do good for society, for the rest of the world, you are going to have to sacrifice something. And you have to be explicit about how much you're willing to sacrifice. Remember with impact investing, I talked about endowment funds and foundations investing in green projects and saying, look, we're willing to accept less than what we would make on a risk-adjusted basis because we're making the world a better place. I respect that. I think we need to be clear that being good requires sacrifice. And much of the incoherence, the inconsistency in ESG and sustainability has come from this marketing of you can be good and you can be more valuable. You can be good and earn higher returns. And finally, I think we have to accept that failure can be a strength. That not allowing entities to fail that should fail actually drags down the entire group. And I think that's happened with these 3 groups, and it happens with any kind of entity where failure is not viewed as an option. I hope you found the session useful, and I thank you very much for listening.